As of this recording in May of 2023, most traders and market watchers were expecting the Fed to halt its interest rate hikes. But now, Fed Chair Powell has indicated that they have not planned for a pause in the rate increases. This unexpected move sent the S&P 500 down and has left many investors and traders scratching their heads, wondering how the heck will this affect the financial markets. The Fed's decision to continue raising interest rates could have several key implications for the markets. Number one, higher borrowing costs. As interest rates rise, borrowing costs for businesses and consumers will also increase, potentially leading to slower economic growth and dampened corporate earnings. For me, this is very important. Why? We're looking at buying a home in Florida as a second home, right? There's that snowbird type place. And we're looking at how we go about and do it. We're not going to pay it outright on cash. We don't want to. We've got the cash. I'm not going to put it in there. You let other people's money work for you. But when the Fed raising rates like this, banks are also tightening. I spent 2 hours on the phone yesterday with a good friend of mine who is a mortgage lender talking about our potentials of what we're going to have to do based on what the Fed is doing. We're talking about banks not wanting to lend to individuals because of the upcoming situation. So it's not only Powell that's slapping you in the face, it's the banks that could be doing it as well. Number two, currency fluctuations. Higher interest rates may strengthen the US dollar, making American exports more expensive and imports cheaper, which could have a ripple effect on global trade and currency markets. Right, think about it. How expensive are things now? Do we really need things to become more expensive because of the way the dollar is going to be fluctuating and the way that the markets are handling that? Number three is stock market volatility. The uncertainty surrounding the Fed's rate hike plan may lead to increased stock market volatility as investors reevaluate their positions and adjust their portfolios. Right now, if we look at our volatility, which is the VIX, I call it the fear factor. When we look at the fear factor, the VIX, it's at roughly 17-ish right now, give or take, a little bit higher maybe, as of today's move. And what's going on there? When you have a market that is going up, the fear is going down. What that means is when the stock is going up, call options are getting less expensive, as are our put options. So fear is coming down. As the fear kicks back in and market volatility starts to rise, it's going to force that VIX back up, which is also going to cause things in the market to become much more expensive. Number four, we're looking at a potential recession. The continuous increase in interest rates might lead to a potential recession, as higher borrowing costs can result in reduced consumer spending, investments, and overall economic activity. As companies face challenges in paying their own debts while trying to remain profitable, unemployment could rise, which is what we want. Economic growth could slow down and ultimately lead to a recession. During a recession, traders and investors might face a bear market, with stock prices dropping and increased market volatility. Whew! Now that was a mouthful, right? I made a statement in there. We were going to see unemployment potentially rise, and I said, that's what we want. Well, that's what the Fed is wanting. The Fed's model, which is very old, very antiquated, doesn't work well. Look at the rate hikes we've had, and we've not seen anything adjust at this point. Yeah, okay, inflation's come down a little bit, but nothing has been adjusted the way it was thought it should have by this point. And one of the key factors the Fed is looking at is having the unemployment rate increase, which means there is more opportunity for someone to find workers at a company, to hire people. And it means it's a little bit tougher for those looking for work. And I am not opposed to that part, right, where there has to be a subtle balance. But the way we're going, my fear is we're going to stop, right? We're going to do what we do with interest rates, and all of a sudden unemployment drop is going to stop, or stabilization, and I think we could potentially be looking at a fall off a cliff where we go from a 3% unemployment rate, 2.5% unemployment rate, to 3, 4, 5, 8, 10%, back to 2009 numbers all over again. In the light of these potential market impacts, options traders should consider the following strategies. Number one is hedging your trades with options. If you don't primarily trade options, you can utilize options to hedge your stock positions, protecting your portfolio against potential losses. For example, if you buy put options, they can help offset potential declines in the value of your stock holdings. Number two, vertical spreads. Consider using vertical spreads, which involves buying and selling options of the same type with the same expiration date, but different strike prices. This strategy can help you capitalize on your market outlook while managing risk. Number 3, volatility plays. Take advantage of increased market volatility by trading option strategies that benefit from changes in implied volatility, such as straddles and strangles. These strategies involve buying or selling both call and put options with the same or different strike prices and can profit from large potential moves in either direction. Remember to always manage your risk and stay informed about the Fed's decisions to adjust your trading strategies accordingly. And there you have it. While the Fed's unexpected continued rate hike plans may create uncertainty in the markets, savvy traders can still find opportunities by adapting their strategies and staying informed. Until next time, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it, and remember, you're just one trade away. Go ahead and check out another great training video right here.